So the topic of my discussion is, aquaculture is a very attractive business for people who are outside, especially the venture capitalist and farmers who wants to go into diversification modes. They just want to start it really small. So I just wanted to show you some of the pitfalls that can happen when you enter into aquaculture and aquaculture farm management in general. This is applicable for farmers who are uh, already doing aquaculture, but at the same time, more applicable for the guys who are going to enter. So it's important uh, that we look forward for such pitfalls. It's a very rewarding in many cases because the returns sometimes, if you usually start as a niche market, aquaculture is rewarding, but at the same time, the risk profile is very, very high too. So it's a very risky endeavor. You believe that there is money to be made, but there is risk both from the production side as well as the marketing side and the financial side and institutional side. Institutional side means regulations and all those governmental policies. All can affect our culture practices. So management and keeping records and making sure all of the cost is accounted for is an important thing within the management aspect of aquaculture. So it requires a lot of planning and a lot of dedication as far as success is destined for. So everybody knows the things that we can set. Most of the people can raise fish, but at the same time, only successful people are able to market it and get a revenue out of it so that you can cover for all your costs. So that's how profit is earned, right? So yeah, I mean, raising fish is not just enough. You need to market that effectively too. So management is key to success. If you look at literature, there you won't find a lot of literature showing that aquaculture is failing too. So you need to make sure you have to have a very scrutinizing eye to before getting into this venture because the literature is too optimistic. They always loudly cheer about the success stories only, but there are stories that are really bad too. So as in any other industry, only 10% or 1% of the folks get trickled through that curtain and gets into that success range. Initially, there will be a large number of ones. Catfish industry is the classic example for that. It was a wild, wild west in the 60s and 70s when the row crop farming was much uh, non-profitable. So there was opportunity for other diversification, and that's how ponds were dug. And but when you are faced with competition or when you are mismanaging farms, you can actually lose your farm pretty quickly. So yeah, so success is something that is defined definitely by the management that you are followed. So watch out for those glorified technologies, glorified budgets that shows that you have 50% returns and payback period of just 2 years. It's glorified only in my view. So there are some fundamental concepts that can be mistaken or misunderstood, or sometimes even deliberately omitted, especially in terms of large capital investment and also grasping those key production concepts and cost concepts are very important before concluding that we are in a feasible range or not, before making those decisions. Uh, I know, I mean, many of the business folks understand the difference between revenue and cost, right? I mean, the difference between revenue and cost is actually the profit. So you can make profit once you start to cover for all your costs. So in this particular graph, you can see that as you produce more number of fish from right to left, you are seeing different ranges of profit. The difference between this green line and the red line, which is the cost, uh, is what we call as profit. So this whole range How can I show? I mean, this whole range of region is actually the profit range. But within that region, if you carefully look, you can see that profit is maximized only at one point. And that is not when you are selling a large amount of fish or not. It's not typically at the highest point of your revenue. It's usually a little bit behind that. That is just because it's a fundamentally proven theory that your maximized profit is happening at lower levels of your maximum revenue. And it's because of diminishing marginal utility, we typically call that, but at the same time, it is because of the marginality concepts within economics. That means your benefits gets initially higher, 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 but after that, after some point, it will slowly starts to go down. So this is what a typical example looks like. Most of the farmers are price takers. You won't get a difference in price because you sell a higher volume. So it's a flat line. So, but the cost is not like that. Initially, the cost is very high per unit of your fish production, just because there are fixed cost or sunk cost involved in it. But as you produce a little bit more, that sunk cost can be covered up, then that marginal cost slowly starts to creep up. And at this point, marginal cost means the additional input cost that you incur for 1 pound of fish or shrimp that you produce. The price remains the same. So when the marginal cost is equal to the price of the fish, that's when that uh, profit is maximized. It's that particular point. So how do you know that? It's not very easy. You just have to look for in your budgets. When you look for accounting for all the cost, you can slowly start to understand that this is where I am maximizing my profit. There are two ways to look into it. One is from your output side, and another is from your input side. Um, Once again, I mean, these are all theories, but in reality is that the marginal productivity needs to be higher. That means for every unit that you're producing, your profit should be going up and up and up. And that's efficient only when you are maximizing that productivity of your input. Input in the sense like let's take an example of feed. When you are efficiently utilizing the feed, which is kind of a metric by FCR uh, or feed conversion ratio, you are actually making that benefit, right? So when you put that feed cost to or price of the feed versus the price of the fish, you typically get a gauge of what is called as the marginal productivity. So it really depends upon those input to output. That means the fish versus the key input price ratios. So in theory, you want to make sure that you have a fundamental idea of all the input cost, how much percentage you are incurring on each of those inputs like feed, fingerling, electricity, labor, and start to optimize from the biggest cost part. So that's why many of the economists or many of the farmers are always talking about optimizing the feed, because feed is typically in feed-fed aquaculture, feed is usually the largest expenditure, followed by PLs or fingerlings and labor and energy and all those things. So it's very important to look into that. Another thing that people tend to forget is the value of the money, right? I mean, if you are putting money from your pocket, still it has a cost. It's just not, it has an opportunity cost, right? So it could have been put into something else that would have given you some sort of a margin. You need to include that as a cost. So the cost of capital is very, very important in industries in US, because the cost of capital is tremendously high. It's usually around 8 to 10%. It's not the bank interest rate. Bank interest rates are usually lower, but your opportunity cost of capital are typically higher than the bank interest rate. So make sure that cost of capital is also included in your budgets. So when you are looking at input, what does this profit maximizing level has to tell you? I mean, so for an example, we'll just take the case of feed as an input and fish as our only output. So when the feed prices go up, typically the profit maximizing level, that the level of fish that you need to produce where profit is maximized is actually at a lower production level. That means you have to produce at lower intensity. When fish prices go up, uh, that level of production, the profit maximizing level of production goes up. So that's because your marginal revenue is higher. In the previous case, or when the feed prices are high, the marginal cost is high. So your level is lower, and when the fish prices are up, the profit maximizing level goes up. So these are two important things. That's why farmers tends to adjust their stocking densities or production level based on what they see as the future. For right now, let's take the case of shrimp farming all across the world. Shrimp farming is going through very low profit margins. Why? Because the price of shrimp has come down a lot because of lesser demand and all those kinds of things, especially with tariffs and all coming. So you can see that the density of production is actually going down. When fish prices goes down, the level of production has to go down so that you don't oversupply a lot and incur those further pressure on the price. So this is typical farm behavior that you need to monitor from the profit side. FCR is a very commonly used indicator for uh, gauging the efficiency of use of feed, right? Yet, FCR is great. It's very easy to calculate, but it does not account for the prices. Remember, it's a ratio of the total feed versus the net gain, right? So it does not have any indicator of what is the price of your fish, what is the price of your feed. So that the efficiency of use also depends upon that price ratio. So it is always better to account for this kind of an indicator. I just gave an indicator called as H. It is nothing but ratios of two actual factors, which include the FCR for sure. FCR over feed cost, which is a proportion of the operating cost. That means the fraction of your feed cost, your operating cost as B, and then the price ratios of fish and feed. If you look, if you put them together, and that if that ratio is lesser than one, it is a better indicator of your total resource use of the feed, which includes the price as well as the quantity. So this can be this number, this H indicator can be affected by not just FCR, but how you are utilizing all the other inputs too, because the operating cost is involved in it. So for example, when your operating cost is going up because of capital cost or labor cost, this ratio can actually go up, right? So that's the meaning of this particular economic efficiency indicator, which is more apt. It's accounting for the largest cost, but at the same time, it's account for the operating cost also. Then we talked about the profit, some of the important inputs, but at the same time, cost. I think the most forgotten or biggest pitfall is actually the cost concepts, misusing or not knowing the actual concepts of cost or lack of accounting of all cost. It's just because whenever you enter into a farming business, you are always biased. You have to be either Buddha or somebody, I mean, who has to be totally denounced every biases when you're entering to agriculture. You are actually very optimistic when you're getting into it, right? So that devotion, optimism, favoritism can all play into that misusing of or lack of proper using of cost concepts. Accountants are the ones that are typically uh, dealing with many of the cost on your tax front, but economists are much more conservative. They they see cost a bit more conservatively than the accountants. So that's why accounting profit and economic profits are typically a bit different because it accounts for some more implicit cost or hidden cost into it. So make sure that whenever you see certain budgets or profitability or cost estimates, whether that is taking care of all of them or not. So the forgotten costs are some of the common forgotten costs, or all of them are actually, some of them are listed out here. Earthwork and construction cost. I mean, budgets typically are annual. And if you are not accounting for your construction costs that you incurred initially and split it across multiple years of your loan, you are actually going to see a higher profit, and you believe that that is going to be the correct one. But after 10 years, your pond needs to be renovated again. That construction cost has to be taken taken from your uh, accounts, and that can actually give you a pseudo profit. And pond renovation is it's classical example, with more intensive aquaculture farming practices, especially outdoor ones. You have to have renovations and repairs more frequently. So repairs and maintenance costs, some of the backup equipments, you may not even use one of the generator that is kept as a backup. So you need, nowadays, even in intensive salmon farming, I'm hearing that you need to have a backup generator, and then you have to have a backup generator for your backup generator. So that's intensive it is. So permits and licenses, legal fees, retainer fees, and once again, the one of the most important one is the cost of capital. The cost of capital is one of the biggest forgotten thing. And in small scale business, there is opportunity cost of all four factors. Opportunity cost of land, labor, capital, and management. So opportunity cost of labor means the value of effort that you put in your farm that needs to be put as a cost to really see the actual profit above all of the risk. Management means you also act as a manager of your own farm, taking care of all your accounting and uh, tax works and all those, or legal works, permitting. All those parts are opportunity cost of management, managing the entire business. So you have to put a cost for that. So the thumb rule is that your salary at least needs to be taken out from the business as a cost, and then only you should calculate that profit. So opportunity cost of land is at least the at least you should put a lease rate, even if you are owning the land. So that's how you come to a true profitable venture. Why? Because if you are getting $100 per acre profit, and you could have lended that land or leased that land for $110, that would have been a better venture rather than doing all these activities and not getting above your lease rates, right? So it's simple calculation, but you often forget those incorporations into your budgets or cost calculations. So opportunity cost is very, very important. So that's what I was saying. I mean, it's the cost of the best alternative actually forgone. So every opportunity, every investment has an opportunity cost associated with it. You could have put that money somewhere else, and that returns needs to be added as a cost to actually see the real profit. Otherwise, you won't be seeing that as a real profit. It will be a pseudo profit. opportunity cost of land, labor, management needs to be summed up. And the thumb rule, as I said, labor and management should be above your salary. Depreciation is another one. You see that the classical example is a car. The moment it leaves out of the lot, it starts to depreciate, right? So it's the same thing in farms. Many of the farms are actually using a vintage capital. It's just because of the reason that either you miscalculated the actual life of the equipment, or you fail to accommodate enough money as cost in your annual budgets, so that you don't have, and in that case, you don't have enough money to buy a tractor after 15 years or 10 years of useful life of that product. So you have to incur a further repair and maintenance, and higher repair and maintenance cost. So it's very important that we need to have depreciation actually accounted using practical life or useful life of each of the product. Remember, land does not depreciate, it actually appreciates, but bonds depreciate. There is no doubt about it. Bonds needs to be renovated, um, and you need to account depreciation cost for your bonds, especially the earthen bonds. So you can see that this is kind of a net returns per acre. When you account for all the cost, your profits for smaller farms, 60 acre and 130 acres, were actually negative. But if you are just accounting for cash cost, you are all profitable at all different scales. But in reality, this is what is happening, and that's why many of the small farms and the medium farms are struggling after 2 or 3 years, because they were making cash. I mean, they were making they were accounting for all the cash costs, but sooner or later that will hit, because many of your assets needs to be replaced, because it has already depreciated, and you won't see those money there for repurchasing those equipment. So that's why, if you properly account, you can really see where you are right from the first or second year itself. A really cautionary word about EBIT and EBITDA, or EBIT and EBITDA. These are also profit measuring terms, which came from a venture capitalist mentality. People who invest from New York and New Jersey or Las Vegas or wherever, whenever they have money, they want to invest in it. So they are the ones who coin this kind of terms and see what is the earnings before interest and taxes and depreciation and amortization. These are 4 or 5 important things that are not accounted in EBIT and EBITDA. So when you look forward, I'm just creating an example for that. When you account for all your variable cost, your net returns were $112,000, which is about 14%. Net returns about total cost, your actual profit was about 3% of the total revenue that you earned. In EBIT and EBITDA, these numbers can be much higher. So because they are adding back all those costs, the amount of money that you paid as interest, administrative expenses, income tax, capital cost are added, depreciations are added back, because they see it with a very different angle. But to me, tooth fairies don't pay for this kind of cost. You do. So the one in the purple line is the most correct way of accounting. That is by accounting every cost, including your depreciation, your all fixed costs, including your opportunity cost of capital, because most of the aquaculture businesses are either small or medium. There are only fewer larger farms that um, look into the EBIT and EBITDA ventures, because those capital ventures are coming in from oil money or other crops or something. So it's a different way of looking at profit. More conservative ways are the best way to move forward for better success. So the underlying fundamental rule is that you make sure almost everybody understands what is an operating cost. It includes all your running cost. Everybody accounts for all of those, but make sure that you include all these ghost costs that are often forgotten that puts you in liability issues later. One of the most important thing is the depreciation and cost of interest, and also opportunity costs for land, labor, capital, and management. So another concept, I know everybody knows this, is time value of money. Uh, uh, you can always debate whether a business yielding $200,000 in 2 years is better, or a business that is making $420,000 in 4 years is better. The answer is it depends. If your inflation rates or your depreciation rates or discounting rates are much higher, that's the one factor that determines the time value of money, because it's kind of discounted, right? So payback period is a simple way of calculating, but it's not the correct way or complete way of knowing what is exactly the right investment or feasible investment in long run. Payback period is just dividing your cash flows, annual cash flows, um, uh, to get the actual number of years it takes to pay back your initial investment. But net present value is a bit more correct way, because it actually sums up all the future profits in a discounted way, using a discounting rate. For example, the discounting rate is the best discounting rate that should be used is the opportunity cost of capital. For example, in US, it's hovering around 8 to 11 percentage. I would say that it's somewhere around 9, 10 percentage right now. But there were times in the 70s and the early 80s when the discounting rates were much higher. So using a bank interest rate is not the best way. For example, right now you use the discounting rates at least as 10 percentage right now for your future investments, right? So every year it is actually losing 10 percentage of the value. And if you account for that future profits together and still get a positive net present value, that means the business is feasible. IRR is nothing but recalculating for an NPV of zero. But if that IRR is greater than your opportunity cost of capital, uh, it is a favorable investment. So these are all complicated calculations, but it can be done in Excel itself. And I have provided all this thing in a small spreadsheet for your use later. MIRR is a more better, a more conservative ones for ventures where IRR is very high. IRR, or internal rate of returns, believes that almost all the returns are put back into business. And we know that when you get 35 percentage as an internal rate of return, nobody will put that 35 percentage back uh, into the business. So probably you will put only 10 or 15 percentage. So MIRR accounts for, or modified internal rates of returns actually accounts for the true value or true conservative value of reinvestment into the business. So that's the only difference between MIRR. So some banks will ask for modified internal returns if the IRR is found to be much higher. Cash flow, one thing that I want to stress is, cash flow it's very important. Profitable businesses can actually run into cash flow troubles, and if that cash flow troubles are in the worst times, when there is capital crunch in the economy, banks may not lend you money. And if you don't have that money to be pumped back into the business in the right time when you need it, the business can fail. And there is a saying that almost half of business failures, that means the 90 out of the 100 that fails, 45 of them are because of cash flow. It's an anecdotal saying, but I think it's very, very true in not only in aquaculture business, but any businesses that are meant for long run, especially in aquaculture. The lifespan or the life cycle of that product is much longer, right? I mean, it may take 12 months, it may take 18 months, some cases, even 24 months of production cycle. Cash flow is very, very fundamental. It's not very common in row crops because row crop harvesting and all happens within 3 to 8 months, at max. So you immediately turn over your crops, but in aquaculture and animal production, it's a bit more tricky. So make sure you are able to cash flow. That means when you account for all your cash inflows and outflows, you still should be positive. Cash flow only accounts for cash cost. So, for example, many of the depreciation and non-cash items like opportunity costs may not come into those picture at all. But still, you need to be liquid. Liquidity is the fundamental thing for cash flow. So, sound business planning, you might have heard about business planning. Business plan has at least two or three important components. One is the marketing plan, how you market your product. The second most important one is actually the financial planning. The financial planning is what we are fundamentally talking about in this particular workshop. There are three important things. One is the profit, which is the revenue minus cost, net worth. How much of that profit is actually being used to pay off your debt, to make sure that your equity or net worth is increasing. That's the second one. And the third one is always having a positive cash flow, making sure that you're fundamentally reducing your debts also, because positive cash flow can be bought in by borrowing more, which will increase your debts, right? So, yes, you need to have a positive cash flow, but at the same time, when you receive your profit, you should pay back your liabilities and make sure your net worths are going up. So, these three things are actually connected, and these are the three fundamentals, legs of your chair, that makes you survive. So financial planning is the most important thing, uh, along with market planning in your business plan. So sound planning is very important. That business plan needs to be made sure it's reevaluated every 6 months or 1 year according to the product cycle that you are involved in. If it is shrimp or if it is a product that has shorter life cycle, you need to reevaluate according to the product cycle. Make sure that you are on top of the things. In conclusion, revenue maximization and profit maximization are two different things. Walmart's work on revenue maximization things, right? I mean, big retailer giants and all, they just want to maximize their revenue so that you can avoid your competition. So they can play on prices and discounts and all those kinds of things. But ultimately, a small scale, medium scale ones are working on profit maximization uh, uh, theories. That means you make sure that you are producing at a level shorter than the revenue maximization, so that you are actually maximizing your profit and paying it back for all your costs. Profits after all your cost is the correct profit. It includes non-cash cost and also opportunity cost. Watch out for those glorified budgets. Question yourself, ask your extension agents for help, because they know who are the correct ones to ask for help, and they can make you understand a bit more about the tricks that are within this within these budgets. Future profits have to be discounted, and that's when you see the real profit and feasibility in the long runs. Update your business plan if you have. If you don't have, make sure you start one and periodically evaluate that. And your strengths, weaknesses, opportunities, and threat also needs to be evaluated for your business growth. So business plan allows you to have SWOT analysis and periodically update that for your business success. Seek extension help. Every state in the United States will have some sort of an extension help. In Indiana, you have Purdue University. In Ohio, you have the Ohio State University. These are land-grant universities with dedicated extension agents who can help you out in those kind of seeking help in the right path to help you out with business plan construction and looking over your businesses. With that, I thank you, everyone. If you have any questions, I want you to refer to two of these books. These are, all these talks and all what I've learned is actually through this author, Dr. Carol Engel. Her books are pretty famous, very easy to understand. So I think Amy and Nicole has given you a copy of both these books. It's pretty easy to read, especially the blue one, and understand all these things. So this talk is actually made out of that particular book only. So happy to have your questions. I'll try to answer to my best of ability. Thank you so much.